3M stock is a stock that dividend investors have been interested in for a very long time for a multitude of reasons. Two of those reasons is they currently have a dividend yield sitting at 4.57%. And then the other reason is this is a company that has been increasing the amount they pay in dividends annually for 64 consecutive years. But when we take a look at their stock, we can see year to date they are down 26.67%. And there is a couple of different reasons for this. Now, obviously, the broader market as a whole has declined a pretty large amount during that same amount of time year to date. We can see the S&P 500 is down 20.3%, but the biggest reason is because of the lawsuit that 3M is currently fighting through. And we can see as of late, we found out that this could end up potentially costing them billions in liabilities. But despite this, we're going to be jumping into my stock valuation spreadsheet to see if this is a stock we should be buying or selling. And we're going to look at 4 different valuation models. We're going to look at Graham's valuation, a discounted cash flow model, multiples valuation, and the dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump into our stock screener, and we'll come up here. And by the way, if you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But we'll come up here and we'll plug in 3M stock ticker and hit enter. And we can see all of this data is going to automatically fill in. Now, if we come over here and look at the dividend data, like I just mentioned, we can see dividend yield currently sitting at 4.57%. Now, payout ratio is currently sitting at about 61.2%, a little bit higher than I typically like to see it. But for more mature companies like this, that's not necessarily a bad payout ratio. And we've already seen that they have a huge commitment to increasing the amount they pay out in dividends every single year. Now, if we come down here, we can see analysts currently have a price target of about $154 per share. And the beta of this company is about 0.92, so typically they're going to be a little bit less volatile than the broader market as a whole. But let's go ahead and jump into our first valuation, which is Graham's valuation. And the Graham's valuation is a valuation model invented by Benjamin Graham, and here's the formula he's laid out for us here. So the first thing we need is 3M's earnings per share, which we have listed right here. We then multiply that by 7, which is the price to earnings of a company with no growth, and then we apply our growth rate projection. Now, obviously, a more mature company like this is not going to grow as fast as some of these newer companies, technology companies. So we're applying a growth rate of about 6. We then multiply that by 4.4, which is the average yield of AAA corporate bonds, and we divide by Y, which is the current yield of AAA corporate bonds. And at the time of this video, that is about 4. So this gives us an intrinsic value of $137 per share using Graham's valuation. Now let's jump over to our discounted cash flow model. And in order to perform our discounted cash flow model, we need to project a growth rate for the future free cash flows for the company. So what I've done is I've looked at the historical free cash flows, and we've seen that they've had an average growth rate of about 7%. Now, when we look at industry expectations as well, I'm applying a growth rate of about 5% for the future free cash flows for this business. I also applied that 5% growth rate to the terminal value, which is the sum of the future free cash flows past the year 2030. I then took the present value of all of these future free cash flows and added them together. I added the company's cash and cash equivalents and subtracted out their total debt to find their equity value. I then divided by the number of shares outstanding to come to a discounted cash flow price per share of $196. Let's go ahead and jump over to our multiples valuation. And typically the idea behind our multiples valuation is we look at companies that are similar in structure and use a price to earnings multiple to apply to 3M to find the intrinsic value. But as I was looking at companies, I really didn't feel like there was currently a fair comparison for 3M. So because of that, I'm not going to use a multiples valuation for 3M. But let's go ahead and jump over and look at our dividend discount model now. And obviously, dividend discount models can be important for 3M due to the fact that so many investors are here solely for the dividend. But if we look here, we can see what I've done is I plugged in the quarterly dividend payout so we can see how much they pay out every single year. And this allows us to see the growth rate of their dividends over the past few years. So we can see it has declined just a little bit. We did have a year with 5.8% growth rate, 2% growth, but the past couple of years have been below 1%. So we can see over the past 4 or 5 years, they have an average growth rate of about 2.3%. I think it will be slightly higher than this moving forward, so I am applying a growth rate of about 3.5%, and after applying our discount rate of 8%, we can see we come to an intrinsic value using our dividend discount model of $137 per share. Now let's go ahead and jump over to our output tab, and here on our output tab, we can see the 3 valuation models we used: Graham's at 137, DCF at 196, and dividend discount model at 137. When we average all 3 of these together, we can see we come to an intrinsic value of $156 per share, which is surprisingly very close to what analysts' current target price is at $154 per share. Let's jump back over here. Now, we are value dividend investors, so we do always want to apply a margin of safety. So if we come over here and let's say we want to apply a 20% margin of safety, we can see based off of this, it's still not within our acceptable buy price. So this is saying this is not a stock we should be buying. Let's say we want to apply a 30% margin of safety. Based off of this, our acceptable buy price for this company is $109 per share. So the spreadsheet is telling us this is not a stock we should be buying. Now, obviously, the news that we do need to be following with this stock is going to be this lawsuit and what's going to end up happening. Are they going to end up having to pay out billions in liabilities? Because if that's the case, then this stock price will obviously begin to reflect that and continue to decline. Now, this does provide an opportunity where the stock price is declining for us to get in at a better yield if this is a company you're interested in. Obviously, the 4.57% yield is much higher than this company has typically yielded in the past. And if we do continue to see some dividend growth, this could potentially be a good dividend paying company long term. But as for me, this is a company on my watch list. I do own a few shares. If they continue to drop, maybe I'll consider adding shares, but I'm going to be watching the lawsuit very closely. But go ahead and let me know your thoughts on this company in the comments down below if you plan on buying or selling. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.